Good morning. I'm Howard Scheck from StoneTurn, and my one big thing for the Securities Enforcement Forum West 2020 is quality of earnings. I think public companies will be under pressure to manipulate their GAAP or their non-GAAP metrics, and they may try to downplay their MD&A or going concern issues. I also wanted to share some StoneTurn accounting humor with you, so I hope you enjoy it.
Welcome back. Our next panel is one of the staples of all of the securities enforcement forums that we do, financial reporting fraud. Whether times are good or bad or flat out pandemic, financial disclosure and accounting frauds are always a problem. And there can be a fine line between optimism and fraud. And this panel certainly understands that distinction better than most people would. We start with our moderator, Howard Scheck. We go back to the 90s when we were both staff attorneys in the enforcement division together in DC. Howard is one of the few SEC enforcement lawyers who's also a CPA. It's a very powerful combination. And it's no accident that he went on to become the enforcement division's chief accountant. He's now a forensic accounting specialist and a partner with StoneTurn. Welcome, Howard. So glad you're here.
Thanks, Bruce. Glad to be here.
Next to me is Jason Flemmons, Senior Managing Director at Ankura with 25 years of experience in forensic accounting, corporate investigations, and technical accounting and auditing matters. Jason has an extraordinary track record of SEC accomplishments. He served in various senior positions, including Deputy Chief Accountant in the Office of the Chief Accountant in the SEC's Division of Enforcement. Welcome, Jason.
Thanks, Bruce. Thanks for hosting.
Thank you. Matt Jacques, we're honored to be joined by you today. He is the current Chief Accountant in the Division of Enforcement. Matt cut his teeth doing both public accounting and forensic accounting at several big accounting firms, and as a staff accountant for 5 years on the front lines at the SEC's Enforcement Division. But Matt, and I'm sure Matt and all of his accounting colleagues have been working 24/7 since COVID hit us all. I know we're all very grateful for your service and for the time you guys are putting in and for taking the time to join us here. Thank you so much, Matt.
Thanks, Bruce.
Welcome. Finally, final piece to this outstanding panel is the perspective of a seasoned SEC enforcement defense lawyer like Craig Martin of Morrison and Foerster. Craig represents directors, C-suite executives, public companies, audit committees, regulated entities, lots of others, and also served himself for over 3 years in the SEC's enforcement division. His experience with financial matters, especially internal investigations, makes him an ideal person to round out this panel. Welcome, Craig.
Thanks very much, Bruce. Thanks for making this happen.
Thank you. Howard, let me turn it back over to you.
So great. Thanks, Bruce. And hello, everyone. I'd like to thank you on behalf of the entire panel for attending this session on financial disclosure and accounting fraud. As you might expect, we're going to spend a decent amount of time addressing COVID-related financial reporting enforcement issues, but we're also going to touch on other hot topics and get the perspectives from Matt from the government and from Jason and Craig and myself from the practitioner's point of view. And Matt's also going to highlight some enforcement actions. So with that, I'll get the ball rolling. I'll turn it over to Matt. And Matt, can you just give us the, from your perspective, what the Commission and enforcement is doing related to COVID issues?
Yeah, happy to, Howard. And first, just to echo again, Craig and the others, thanks again to Bruce for powering through and managing to keep this conference going. I know it's a favorite of mine to attend, and I'm obviously honored to speak up here. And finally, thanks everyone for your time watching. As I must do, I'm going to give my SEC disclaimer. The views expressed today are my own and do not necessarily reflect those of the Commission, individual commissioners, or my colleagues at the SEC. Additionally, I'm going to add my new personal Zoom disclaimer. Any views expressed by any screaming children in the background or on my screen are their own and do not necessarily reflect my views, reflect how said children have been raised, or the opinions we hope they hold once they are grown. It was a little interesting. This morning, I was sitting with my 7-year-old going over her schoolwork from yesterday. And during the course of it, I got a chuckle out of this when I reflected on what I'd be doing later. She told me that I asked too many questions. My questions were not fair. She would not produce her work to me from yesterday until she had more time to review it. Our conversation was costing her valuable screen time. So I think I'm warmed up for this panel. Folks from the defense bar around, and I'm ready to go. So back to your question, Howard. How are we dealing with accounting and disclosure investigations during the current situation? So, it's interesting, and I know we prepped for this, and I've been living it every day since this began with my colleagues. And so I took some time this weekend to sort of step back and reflect and look at all the SEC has accomplished in the past few months. And it's really quite staggering when you see both the amount and quality of effort that the agency has engaged in during this time. For those of you who haven't gone there, and I'm sure many of you have, the SEC.gov website has a fantastic resource page, the COVID-19 response page, that lists out all the different activities we've been engaged in. And that page is a great example of what, in my opinion, has been a real strength of us during this time, which has been timely and transparent communication. My colleagues today have already spoken about, and we'll touch on a number of topic areas, but I'm going to focus specifically on financial reporting, accounting, and auditing areas impacted. And I'd like to note the following, and for those who haven't read it, early on in the crisis on April 3rd, Sagar Tiatia, my fellow chief accountant in OCA, Maine, put out a public statement titled Statement on the Importance of High Quality Financial Reporting in Light of the Significant Impacts of COVID-19. And this guidance, I thought, was incredibly useful at the time. And as the situation has progressed, it's become even more useful. It outlines a number of challenges companies may face in financial reporting results during this pandemic. And most notably, there's a section in there where Sagar laid out some of the many, and I'm quoting, some of the many accounting areas that may involve significant judgments and estimates in light of the evolving status of COVID-19. And from there, he went on to list out things such as fair value and impairment considerations, leases, hedging, revenue recognition, subsequent events, as well as a number of others. And with regard to these areas, he also noted certain judgments and estimates can be challenging in an environment of uncertainty. And as OCA Maine has stated, they have not objected to well-reasoned judgments that entities have made, and will continue to apply that perspective. And I think that part of that statement is a really important one, and one that we've been thinking a lot about. We're all very aware of the challenges that companies and individuals are facing during this time with regard to financial reporting, accounting, auditing. Having said that, we're also very much aware of the history of economic downturns and how these situations can reveal past errors or frauds that may have been ongoing. And while, we are not in the business of second guessing well-reasoned accounting judgments, particularly those that are also appropriately documented, we are actively monitoring now to make sure that companies are not taking advantage of this time to hide past issues. You take something, for example, like impairments, right? If a company has knowingly been sitting on an asset that should be impaired and now using this time to impair said asset, we're thoughtful about that and making sure we're monitoring the market for those types of situations. And in addition to the COVID-19 related focus, we continue to be active. As you'll hear in more depth later from the keynote, Steve Pekin, co-director of enforcement, we're finding ways to accomplish our work. We've got these ongoing investigations. I know Jason, Howard, and Craig are going to talk about, their experience with that. And yes, the conditions are different, but we haven't stopped our efforts to fulfill the agency's mission with regard to protecting investors. As many of you know, though, the accounting and disclosure matters we investigate are some of the more complicated and resource-intensive efforts on our docket. I personally spent a lot of sleepless nights during the early innings of this pandemic, worrying about how we would keep some of the investigations moving forward. And as usual, our teams have risen to the challenge. Our people have adapted. I only have anecdotes of what I've observed so far, but across the division in our accounting and disclosure investigations, I'm seeing innovation take place. It reminded me a little, I don't know if anyone's in the podcast, but I was listening to a podcast recently about Keith Jarrett and the unplayable piano. And it's a story of a concert he played at the Cologne Opera House. And he walked in, and even though he had a broken and out-of-tune piano, Jarrett found a way to play one of the most memorable jazz piano concerts of all time. Now, I don't expect our people to be turning out legendary jazz, but what I have observed is that people adopt, and our people are smart, they're talented, they're experienced. And we're seeing things, or at least I'm seeing things where, that commuting time people have had has now been reinvested in reviewing documents. or things that, as many of you know, the SEC is probably a little more paper heavy than we want to be. Things that have been done in paper are now being done electronically by force. And the result of that is we're getting more efficient and effective review or analysis of certain things. And so seeing all these things and all these adaptations has been, inspiring to me and something that, continues to surprise me on a daily basis, how people are working around some of the challenges we face in our investigations. Now, look, of course, we would much prefer to be back operating in the office as we normally would. But overall, we're finding a way to move things forward and we're adapting.
So great, Matt. Thanks. So I want to turn it over to Jason next. And Jason, can you give us your thoughts on what you're expecting to see in your practice regarding COVID-related enforcement issues?
Yeah, look, as I think back on, there's a variety of different themes that we've all encountered in the accounting and auditing and disclosure arena from an enforcement perspective over the years. And, a lot of them do fall squarely within the rubric of significant accounting estimates, which is what Matt was just referring to. That was also referred to in that release from the SEC. But there are several that stick out to me that I think are probably more front and center, more immediately. The first of which I think would be more in the realm of accounts receivable. Clearly, given the economic conditions and companies and customers and vendors may having trouble making payments to companies and satisfying their debts, I would think that that's going to be an area that we'll need to get a close look at. The criteria under GAAP is not that whether or not a debt's going to be paid on schedule, but whether or not it's probable that the recorded balance will be paid in full. So I think that's something that companies are looking at and is going to be a heightened risk area. Another that I think is more, newer just because of ASC 606 and the new revenue recognition standard relates to what's known as variable consideration, which is a component of revenue recognition. And that's contrasted from the prior standard 605, where historically, if you had some sort of future contingent event that you were going to record revenue on, you had to wait for that event to occur before you would actually record it. Now, under the 606, one of the changes is that that's considered variable consideration, and you have to consider up front whether or not you believe that contingency will be resolved and that it's probable that it will be resolved. So the reason I raise that is it could very well be that companies who have been very much adversely impacted by COVID-19 may have previously believed that certain earnings triggers were going to occur that had been considered, they had considered to be a variable consideration in their pricing, and they were reporting revenue on that. But GAAP does require you to reassess that and also to consider market conditions and market volatility. So I think that's an area that is definitely smack dab square in the middle of a risk area that we're seeing. And I think another area that we're hearing a lot about, and I also saw in the SEC release, related to impairments. And I think that issue is real. But when I think about impairments, so for example, property, plant, and equipment, one of the criteria there relates to whether or not there's been an adverse change in business climate. And to the extent that that's occurred, that could be an indicator that that an asset like a piece of property has been impaired. However, I think the evaluation that one undertakes for that is one, to determine whether or not that impairment is permanent as opposed to some temporary event. And as we think about the impacts of COVID-19, right now, no one knows how long this is going to go. No one knows how long this is going to impact the economy. But at a minimum, it's certainly not clear that this is going to be something that's going to be, that could cause a permanent impairment on an asset, especially given that when you do that evaluation, you consider the useful life of that asset, and cash flows could be, generated to recover that asset over a long period of time, and would therefore not render that asset impaired. So So those are some of the few, I think, highlights that I think are relevant. But I think the most important thing is companies undertake these evaluations, and I believe this was in the OCA release, is to apply well-reasoned judgments. And that's a phrase that was quoted, well-reasoned as a kind of a paradigm that OCA will not object to. But I will say that in order to demonstrate that a judgment is well-reasoned, it has to be, documented. So that's one thing that I would continue to, harp on, which I, have been doing for many, many years when I speak on panels like this. So those are a few initial thoughts on that topic.
Thanks, Jason. And Craig, I guess I'll throw the same question out to you. Are there any specific enforcement, COVID-related enforcement issues you expect to see in the future? But also, if you could give us your experience so far on how you've been dealing on your cases in this particular environment.
Sure. And so, all the points that Jason just made are interesting, and I fully expect that those will be surfacing in the weeks and months ahead. The enforcement docket does tend to lag prevailing business conditions, and so I would say that so far 2020 looks a lot like the end of 2019. Coming into the year, I would have said we're going to be focused on write-downs and earnings management, and to a certain extent communications with auditors as areas where enforcement gets quite interested, and so far that's been reflected in many of the matters that the staff has brought in the last few months, and we're seeing reflected in our cases. I think that, and I'm sure we'll be talking about this, but the pressures that folks within large organizations feel in difficult economic circumstances will no doubt animate decisions that get made from an accounting perspective, and I think that those are going to be challenging for companies to identify, prevent, and correct, as well as address in an enforcement perspective. Picking up on Matt's comment about adaptation, I think the commission owes a lot to the union, which I know in years past had promoted remote work and made adjustments for that. The commission has made adjustments for that. The staff, in my experience so far, has been more adept than we have in adjusting to a remote work environment. Our remote work policies at private firms seem sort of quaint now compared to the staff, where the commission seemed like it was rolling pretty efficiently almost from day one. My experience, consistent with what Jason Lee and others on the earlier panel said, has been that the staff has been pushing ahead with robust investigations. At the same time, has recognized some of the challenges. We talked, or the earlier panel talked about the challenges of doing WebEx testimony, even more mundane, but an equally significant challenge in financial reporting investigations has been collecting data, collecting documents, and trying to do that in an environment where people are being ordered to shelter in place, trying to do that in a context of not just in the United States, but in foreign countries who have their own rules and regulations. That has been a challenge. And to date, the staff has been willing to accommodate us and has been understanding about that, the fact that there are going to be some additional delays, so long, I think, as the staff is satisfied that we're making steady progress and taking those obligations seriously.
Thank you, Craig. I mean, I'll just add my 2 cents, I guess, on the accounting issues and expand a little bit. Is on one thing that Jason said. I mean, I can't stress enough how important contemporaneous documentation is in this environment to ward off or get the best result potentially, and in a future enforcement investigation, if that occurs, as we all know, even if the company ends up having to restate, or if the SEC starts investigating, the best defense is well-reasoned, as Jason said, documentation and support for what they did. So I just wanted to echo that. I think the other important thing is continued assessment and evaluation of what aspects of the company are being impacted by COVID. Obviously all companies are going through that right now, but since it's so unpredictable and things are changing, that needs to be a continued process. It can't just be done once. The companies have to keep doing that. The other two high-level points, and then turn it back over to the panel, is that going concern is obviously an issue with a lot of companies that have to evaluate that. And I thought it'd be useful to point out that this is the first recession or downturn, if you will, that companies are having to deal with a relatively new accounting criteria where the management itself has to assess going concern. It was primarily thought of as an auditing or an audit related issue, but now management has to assess that. And if they think that the criteria are triggered, then and they think those are going to be mitigated, if you will, they have to provide certain disclosure on that. So certainly with companies that are filing, if they have year ends on March 31st or even coming up in June, those are going to be things that the companies and I think the audit firms are going to be wringing their hands over. And then one other issue is debt classification. It might not be something folks think of right off the bat, but if a lot of companies are in a situation where they may be in default or need a waiver from their lender or trying to renegotiate that, and if something is long-term, if they're in non-waiver status, it might have to potentially be considered short-term and reclassified on the balance sheet, and that could cause issues. So those are some of the things I thought I'd bring up. I guess I'll just throw out to the panel, and as far as the enforcement topics, we've mentioned those mostly, and we can get into those. But are you seeing any issues that companies are currently dealing with and even preparing their financial statements? For example, how are they getting inventory done?
Well, I'll answer that from the standpoint that I'm certainly hearing from clients and others that I think the recent events have really exposed some questions and potential issues around internal controls. Mainly because while we've been living in a virtual accessible world for a long time and we're much more data driven, I think companies are still not necessarily used to having to engage in operations and financial reporting functions in this way, in this remote way, and on such a broad scale. So some of the questions that have arisen are very central to, for example, the monthly closing process. I think that the companies have been used to having accessibility of people next door, or being able to print out reports and walk down the hall and have somebody sign off on things. And I think logistically that has created some complications. But I think another thing that I think either Matt touched on or I had heard earlier on another panel, which I think is very important, is on the review and approval controls. Whether or not the current environment may be creating some issues related to potential circumvention of controls, or exposing the fact that there aren't certain controls in place that really should be to foster one of the basic tenets of internal controls for financial reporting, which is segregation of duties. How are the controls keeping those intact? So So those are certainly some of the things that I'm hearing. And then I think also along the lines of, with regard to SOX 404, certifications, and the ability of companies to really perform those quality assessments. Fortunately or unfortunately, COVID-19 hit during more or less the calendar first quarter of 2020, and so when you're thinking about the internal control environment that's being assessed and what needs to be certified or looked at, we're really talking about the first calendar quarter of 2020. And the criteria for that is different than it would be if it were a year-end evaluation. But that said, it does raise questions on companies' abilities to, perform a fulsome assessment. For example, if that's being done by internal audit, or if that's being done by a separate SOX group. Have there been, the inability to travel? Has that become an issue with being able to go out into the field and to perform, process walkthroughs and have access to people that you need to be able to do those assessments? So those are, again, some of the initial questions that I have seen crop up.
Yeah, that's helpful, Jason. Matt, do you have any thoughts on inventory and how companies are doing that?
It's very specific, Howard. Right?
Yeah.
I hope they're doing it accurately and consistently from period to period. One thing I will say, Howard, and I can wrap inventory into this is, you mentioned the going concern management assessment, and you mentioned disclosure, and I think that's going to be critical when we look back years from now at this time, as companies are, faced with operational challenges. Getting the accounting right is obviously important, foundational. But making sure if they're doing things different in how they account for things or changing assumptions in certain ways, that disclosure is appropriate. And I think that's going to be a differentiator going forward here. Craig mentioned that we do have a lag, obviously, and when we open the investigations, investigate, and ultimately bring actions. I expect that if actions are brought on conduct during this time, those disclosures, particularly around accounting, are going to be critical to sort of making or breaking a case. With regard to inventory, I'd lump it in with everything else. I think companies are facing very interesting times. Jason pointed to the control structures potentially being exposed and weaknesses within them being exposed, things that were paper or manual. I mean, there's nothing more manual than doing inventory counts, right? So how are companies adopting? How are they adapting to that? Are they putting off counts? Are they doing roll forwards? Are they, disclosing that they may not have an accurate count on inventory? And we're seeing that when I'm reading articles and seeing companies, disclosing things about the challenges within there. And that's something that, we're going to continue to watch.
I'd just add to that, Howard, that I hope that as talking about controls in terms of exposing weaknesses, I'm hopeful that the staff is also going to understand that so much of what the companies are dealing with here and their systems and controls have been designed in a way that could not have anticipated what we're dealing with now, which is, essentially unprecedented since the Great Depression. And I hope that as issues surface, weaknesses surface, that the enforcement staff is going to take into consideration the unprecedented nature of the events that precipitated those issues.
Thanks, Craig. I mean, just one quick point on inventory. What I've been hearing is that, companies that are, and probably the large accelerated companies that have more of a perpetual, not quite real time, but, really up-to-date inventory systems where they're constantly checking and updating them and also have good internal controls are obviously going to have an easier time in this environment than companies that rely on, say, a wall-to-wall physical inventory to get their inventory straight. So I guess we'll see how that shakes out between the larger cap and the smaller cap companies.
Yeah, and the last point on inventory, Howard, obviously companies are going to be faced with interesting challenges estimating excess and obsolete inventory, determining, what is actually having value, what may not have value going forward. And, that'll be something that, we'll see evolve, I think, through the course of the year, just given the changing nature of the overall economy.
Yeah, absolutely. That's an excellent point. I agree, Matt. But does anybody have thoughts on auditors' ability to get the audits or reviews done in this environment? Anyone want to weigh in on that?
Well, I think that was that was kind of addressed. There was a panel earlier where there was someone from KPMG who had talked about that. I don't have more to add on that topic, but I would, if you don't mind, I would like to follow on to something that Craig was saying about the SEC and hopefully there's some level of understanding and sympathy for companies that are going through this for the first time. And yes, it's going to expose potential weaknesses in internal controls, but it's going to be virtually impossible for companies to necessarily identify all of those potential weaknesses right off the bat. But I think that where the enforcement arena really kicks in here is to the extent issues are identified and that there are weaknesses that do crop up during these assessments. It's how do companies handle those? The first analysis is do these fall into a material weakness bucket, or are these more in the significant deficiency bucket? And that's been a long-standing enforcement focus area, given that material weaknesses are disclosed publicly and significant deficiencies are not. And there's really no bright line between the two. But to the extent there are issues that are identified, I think there should be some careful analysis of where that lands in either of those particular buckets.
Yeah, obviously the another topic is MD&A. There's lots of guidance that the commission has put out on what companies should be addressing there, and the big four firms have put out, and other firms have put out some guidance on financial reporting issues. So anybody have any views on how the clients are handling preparing MD&A, or what they should be thinking about there?
I'm happy to give a couple thoughts on that. I mean, again, we're in the first calendar quarter of 2020. And so a lot of companies will be filing their 10Q and providing an MD&A in the 10Q. And again, the threshold and the criteria for MD&A in a quarterly filing is different than it is in an annual filing. The focus in the quarter is really on changes in financial performance. And so one topic specifically in this current environment would be how COVID-19 is impacting, a company's financial performance. And, I would, offer maybe a yellow flag here in potential enforcement area, just given that this does follow a potential theme of what other cases have been, brought in the past. And that is, where there's been instances that, companies have had pre-existing performance issues, financial performance issues, that could potentially be lumped in with COVID-19, when in fact they were longstanding pre-existing issues. I think that's something that I think will be potentially of interest. Another related topic would be where companies are maybe doing things to extend their or preserve their liquidity, or I heard we talked about earlier the topic of debt covenants, doing things, legitimate things to, keep debt covenants satisfied. I mean, an example of that would be, holding up, payments to vendors, waiting, a long time to really get those bills paid out the door. Again, there's nothing wrong with that from an operational perspective, but there have been cases on that very point where companies have been able to prop up liquidity and other financial performance metrics by doing those things and not disclosing that in their MD&A, which, impacts trends and impacts, again, their ability, to keep those things satisfied. So those are a couple of thoughts on disclosure.
Yeah, and Jason, I'd go back on echo the disclosure comment and also point out, something that we're monitoring for is inconsistencies as well, right? If companies are disclosing that their financial condition is fine, yet we come to learn that they are doing things out of the ordinary or inconsistent with past practices that haven't been disclosed to investors. I think we're going to be very conscious and aware of that as we move forward as well.
As far as non-GAAP metrics are concerned, does anybody have any concerns that companies might be monkeying around with how they're making adjustments now in this environment?
Well, that's been an issue that's been around for a while, and I think COVID-19 certainly invites the potential for companies that may want to seek making adjustments related to COVID to their non-GAAP financial measures. And this is, again, it's an area that's not entirely clear on what may be allowed, may not be allowed, but I think that the way that the industry is trending and the way companies are starting to really pay attention to this is to be, being cautious on trying to include impacts or portraying impacts as being related to COVID that are really more issues that are in the core operations. So if you were to, exclude, certain expense items or certain loss items that companies believe arose from COVID-19, but were really more, again, run-of-the-mill, ordinary course operational issues that may have been impacted by COVID-19, but are not specifically linked, I think that's where it gets more dangerous to try to carve those things out. And back to Matt's point on consistency, I know that the SEC and the DOJ have taken positions in the past related to companies who have made changes to how they are calculating and presenting their non-GAAP measures, and they were inconsistent from prior quarters or prior years, but those changes were not transparent, were not disclosed, and so to the extent there are modifications the companies are making to how they are presenting non-GAAP measures, I completely understand and agree with that point that I think companies should be cognizant of how those are presented and not to suggest that they have not made any changes when in fact maybe they have made some changes.
I mean, misleading non-GAAP financial metrics are something we continue to investigate. We brought a series of cases last year on the topic, and we continue to investigate exactly what Jason said, where the disclosures are inaccurate, they're not consistent from period to period, or the disclosure is lacking. And it is something we expect companies will be using more non-GAAP metrics during this time to compensate for some of the weaknesses potentially, and how they're doing their financial reporting overall, and to get information to investors. I mean, it's really important to get information to investors. The chairman, Chairman Clayton and Bill Hinman put out a statement on April 8th, I believe, that spoke a lot to the need of investors to get forward-looking information, in a way that they haven't necessarily gotten in the past. That not just the stock language, but real-time, current focus on the current situation guidance out there. And so we expect companies to use non-GAAP metrics. GAAP is always the foundation. We much prefer when you can reconcile back to that. But we're going to be on the lookout for people, abusing those non-GAAP metrics or at least, representing them way and that is not transparent to the investors.
And I think a related point on that is also disclosure of key metrics or, key performance indicators, other than non-GAAP financial measures. And this all falls under, MD&A. I think there could be potential for companies to modify, what their publicly disclosed, key performance indicators are, and perhaps maybe still using, pre-existing indicators and metrics internally, to manage the business. And, that's an area, again, that, has been a focus point, because the rules do say that, companies need to disclose or consider disclosing key performance indicators that management uses to manage the business. And I believe there was a release that came out back in February, a couple months ago, that provided further guidance on this topic that kind of reminded but added a couple of things that were more or historically relevant to criteria to consider for non-GAAP financial measures that are now kind of being folded into the guidance for KPIs as well. So again, same idea as what we were talking about with non-GAAP that also pertains to key metrics.
Yeah, I wanted to leave a little bit of time for Matt to go to highlight his enforcement cases, but before I do that, I just want to make sure, Craig, are there other quickly non-COVID related issues that we should be discussing so we don't focus everything on just COVID?
I actually think Matt's about to tell us about a few of those very things and some recent enforcement activity.
So we'll just go right to that then. That's fine. Thanks.
So I think we're running up against the clock a little here, but yeah, look, we're continuing to, bring or investigate and bring non-COVID related matters. Obviously, a couple we've seen during this fiscal year include Northwest Bio, which follows a trend of cases we've brought where companies failed to resolve material weaknesses over an extended period of time. Material weaknesses, internal controls, internal accounting controls continue to be a focus area for us. Calumet, which I thought was an interesting case, maybe we can pause on that one, where the company essentially had to restate its earnings release because of failures in their accounting systems, and they went out too early and materially misstated their financial results, having to shortly thereafter go back and amend that. That's a case that I think, I was saying earlier to the panel in our waiting room, we have a lot of cases where the fraud is clear and people look at them and sort of shake their head and say, well, I'll never do that. I think the Calumet situation is one that a lot of people have probably grappled with, right? Trying to get the numbers done by a certain time, rushing. There's some errors, making judgment calls about whether to go out. And I thought it was a great case to remind folks that when you're faced with information that says your financial statements might not be accurate, it's a time to pause and really reassess what's going on before going to the market. I don't know, Craig, if you had any thoughts on that one.
Yeah, no, Matt, I thought that case was particularly apt for the moment that we're in. Calumet ran into trouble because they were trying to implement a new enterprise resource system that resorted, where they had to resort basically to doing manual tracking of things like accounts payable, accounts receivable, inventory. And so there were these yellow flags there that I think the staff believed or concluded that should have caused them not to proceed with an earnings release. And I think we're going to see versions of that during this COVID crisis, whether it's because systems aren't working as anticipated, or there are gaps in personnel, or sources of information that a company relies on are less reliable. As companies resort to Plan B, they're going to have to ask themselves, is this adequate for us to go forward and make a public statement based on? And I thought Calumet was very instructive for this moment.
So, I see Bruce on the screen here now. So are we head there? Bruce, I gotta close with one thing if I have a minute. Do I have a minute?
Absolutely.
So I told the story earlier of my daughter questioning my teaching tactics. And I just want to let you know that ultimately she acknowledged that I was right. And we reached a settlement where she took a two-hour bar from screen time and, punishment to determine later with chores. But always trust your regulator, Bruce.
Hey, so Matt, you should know you got rave reviews on your disclaimers.
Matt, tell her to hire experienced defense counsel next time, okay? Because we could have done much better than that.
Thanks for being up here, guys. It was a pleasure.
All right, thanks, Howard, and great job. A very talented, very experienced panel. And I agree 100% with the comments in the chat. Matt's SEC disclaimer should be the new Zoom call standard. No question. No question at all. So our next panel is a unique one. It's called Silicon Valley Spotlight. It starts at 11 a.m. and we will be right back.
Thanks, guys.
Thank you.
Thanks.